Great. Thank you very much, Professor Agrawal. And hello, everyone. Thank you for joining us for this afternoon's panel on digital assets. My name is Chris Materi, and I'm a first-year MBA student at the McDonough School of Business. Prior to starting my MBA at Georgetown, I worked at CME Group in New York City and was on the team that helped launch the first regulated Bitcoin futures and options contracts, sparking my passion in the cryptocurrency and blockchain space. As someone who was looking to pivot into a career in this new and exciting industry, it was Georgetown's commitment to the digital asset space that drew me to this prestigious university for my MBA. Led by Professor Rina Agrawal, the Center for Financial Markets and Policy has become renowned for its support and dedication to the digital asset space and new blockchain technologies. One example of Georgetown's commitment to the digital asset space can be seen through the new FinTech Fellowship that they are offering to MBA students. I'm extremely honored to be the first recipient of this fellowship, made possible from the generous support of the University Ripple Blockchain Initiative. Through this fellowship, I have the opportunity to work on cutting-edge research with faculty and take part in special networking opportunities put on by the center. I've already begun working on a research paper with Professor Alberto Rossi's help on the institutionalization of digital assets and look forward to sharing it with the center later this semester. Leading into today's panel, digital assets are no longer a fringe topic, but are now embraced by some of the biggest names on Wall Street. A recent survey from Fidelity found that of 774 institutional investment firms they surveyed, 80% found something appealing about digital assets and 36% already had some exposure to them. Whether it is the introduction of futures contracts tied to cryptocurrencies or the potential launch of a digital asset-backed ETF, it is very clear that institutionalization of this space has already begun. And as the price of Bitcoin recently hit a new 2.5-year high and set a new market capitalization record of $330 billion, I couldn't think of a timelier panel. So on the back of this, I have the privilege of introducing today's panel, which will talk about the future of digital assets. Our moderator for today's panel will be the esteemed Georgetown Law School professor, Chris Brummer. Professor Brummer serves as a professor and faculty director within the Georgetown Law School. Professor Brummer is a renowned speaker on fintech, cryptocurrencies, and financial regulation. It is also my honor to introduce our other panelists, Perianne Boring, Zoe Cruz, Daniel Gorfine, and Sarah Olsen. Perianne Boring is the president and founder of the Chamber of Digital Commerce, which is the world's largest trade association representing the blockchain industry. Perianne was ranked as one of Forbes' top 50 women in tech and one of the 10 most influential people in blockchain by CoinDesk. In addition to her work with the Chamber of Digital Commerce, Perianne serves as a distinguished fellow of Georgetown McDonough's School of Business. Our next guest is Zoe Cruz, who rose to the highest ranks of Wall Street while serving as the co-president of Morgan Stanley. Zoe then went on her own into global investing before gaining deeper experience with new disruptive technologies in fintech through her work with Ripple. In 2006, Zoe was ranked number 10 on Forbes' Most Powerful Women in the World list. Our next panelist, Daniel Gorfine, is the founder and CEO of Gattaca Horizons, which is a fintech advisory firm. Previously, Daniel worked at the Milken Institute and was appointed by the chairman of the CFTC to become the federal agency's first chief innovation officer. Within that capacity, Daniel led the commission's new technology, innovation, and regulatory modernization efforts. Daniel is also an adjunct professor at Georgetown University's Law School. Finally, our last panelist is Sarah Olsen, who is currently an executive director and head of business development for Coin Systems at JP Morgan's new business unit, Onyx. Prior to joining JP Morgan, Sarah was a managing director and head of business development at Gemini, a market-leading cryptocurrency exchange. Sarah is a fellow Hoya and received her bachelor's degree from Georgetown in 2009. So without further ado, thank you again for joining us, and I'm sure I speak for everyone in saying we all look forward to hearing this panel. So thank you.
Well, thank you so very much for that introduction, and thank you for this opportunity to come to, even if only virtually, the other side of campus to all of our friends over at the McDonough School of Business. We have a great panel, and it's one that I look forward to learning from. When the business school and the law schools get to combine on things, usually some good things happen. And this is really one of those great opportunities for me as a legal scholar, just to sort of listen to some of the real experts. Let's maybe start off with the panel by some basics. I am a lawyer, so we like to sort of think about definitions, especially when you use something like cryptocurrencies. One thing you kind of notice is that there's a difference between what a cryptocurrency means as a term of art, and there are different kinds of categories and ways in which you classify sort of what a cryptocurrency is. And then there are obviously sort of legal questions, and some would say more precise, some may say less precise definitions as to what a cryptocurrency is. But maybe starting off with you, Sarah, and then maybe to Perianne, we have these words like cryptocurrencies, utility tokens, stable coins, sort of flown around in the popular discourse and between many people in the ecosystem. How do you conceptualize the differences between some of these really key and foundational concepts in the market, and where do you think sort of the conceptual difficulty lies? Because they're not always used in the same way. I mean, particularly when trying to figure out, well, what's a utility token, what's a stable coin, and the like.
Yeah, we definitely like our jargon in this industry for sure. I think sort of back to basics, it's really important when we're talking about cryptocurrency to understand that we're talking about software. So, a blockchain is computer software that uses cryptography to send, store, and process data without the need of a central authority. And what that means is that any device running the software anywhere in the world acts as a record keeper, enabling true peer-to-peer transfer of data. And this is something that we haven't sort of seen before. The first application we've seen of this technology is value transference, and the value that's transferred by this technology is what we're referring to as cryptocurrency. We're using this technology, we're using this term really, really broadly in our industry, but I tend to bucket it into, two categories. The first is what I call representative cryptocurrency, which is basically any monetary value that, is transferred via a blockchain. And that can be anything. I mean, that can be fiat deposits held at a bank, it can be securities, it can be loyalty points, it can be your avatar. But it's really, using the blockchain as a tool for record keeping and ownership transference. The second category, and I actually think this is sort of significantly cooler, is what I refer to as native cryptocurrencies, which is basically the currency at the base layer of these computer protocols. And so something like Bitcoin, and its function to the Bitcoin blockchain is it's not just a unit of value in the Bitcoin blockchain, it's also sort of the currency that powers these decentralized systems. So remember, again, we're talking about these distributed computer networks, with participants all over the world. There's not an easy on-ramp or on-ramp. So you need a native economic system to the software. And that's exactly what these native cryptocurrencies do. So yes, it's a unit of value in terms of transferring money via the systems, but it's also, the currency that needs to be paid into processing data. And it's the currency that's awarded for those that are, processing and maintaining that data, in terms of record keeping. That's a process, typically referred to as mining. And so, this is not just it's not just monetary value that's transferred via blockchain. It's really an entire economic system embedded into software itself. And again, there's a lot more categories and a lot more terms for all of this, but I typically bucket into the two sort of, representing value in the real world and representing the value sort of inherent to the software.
Yeah, very well said, Sarah. I'll kind of break down how regulators are looking at these tokens in the US at the federal level. So FinCEN was the first US regulator to issue guidance pertaining to convertible virtual currencies like Bitcoin, where they have said that they will be regulated like a currency. The second regulator to come out was IRS, defining them as property. And then the CFTC has defined them as a commodity. And then the SEC has said some may be considered a security. So depending on the facts and circumstances of a particular token and how it operates, it could have a variety of different regulators with jurisdiction over the use of that token. We are seeing a proliferation of digital tokens being entered in the marketplace from a very large range of different actors. Cryptocurrencies like Bitcoin and ETH are really the innovations that are leading the way. Over 2/3 of the total market cap of all cryptocurrencies is represented by Bitcoin. But then we also have cryptocurrencies that have been introduced that are not intended to be used as a currency, which are in many cases what utility tokens are. Stable coins being pegged to something else like a US dollar, and really being a representation of a dollar or a digital dollar. And then you also have to look at what the central banks are doing. So we have many different central banks. The majority of central banks around the world today are either interested in or already experimenting with central bank digital currency. And then also commercial banks like JP Morgan and Wells Fargo have digital cash programs that they're working on as well. So I think one of the big questions that we have out there is, as you're seeing many different stakeholders starting to issue these digital tokens, how are they going to operate in this new digital financial ecosystem? And that's what's being built right now today in an incredibly just fascinating area of innovation to explore.
And I should have given everybody the opportunity to also expound on your incredibly impressive biographies, as modest as you all are. So please do so, and we'll do it through the next time around. Again, Perianne from the Digital Chamber of Commerce. And Dan Gorfine, I want to sort of build off of all of these terms that we've just now heard. I mean, you've had experience over at the CFTC, being the really director of Lab CFTC and all the many other things that you're doing now. Legally, right? So we've heard these terms, central bank digital currency. We've heard sort of different ways of thinking about what a cryptocurrency is in terms of its functionality, whether or not it's supposed to operate as, some kind of thing similar to common equity, whether or not it is supposed to have some kind of other utility. What's the legal significance of these terms of art? Just particularly for some of the folks on the business school end who are really grappling with why there is this regulatory overlay in the first place.
Sure. Thanks so much, Chris, and great to join all of you. I got to say, I mean, Perianne, that was an excellent description. Sarah, I think that was one of the best overall explanations of what people are talking about when it comes to crypto. So I really appreciate that. And I might just for a second, pick up on that thread, and I'm going to be even more simplistic in the way that I come at this. I think when people are talking about crypto and regulation, they are bringing in so many different concepts. And to boil it down, I think that there's number one, there's the bucket of the technology itself, right? So when you're talking about cryptography and tokenization, and what does that mean for securing private keys and custody of digital assets? When you talk about the blockchain, these are new rails, new ways to transact these tokens. So there's a question around technology that poses a regulatory challenge. The next bucket is what you're asking about, Chris, which is, well, what's the instrument? What's the asset? And at the end of the day, in many instances, this actually isn't that exciting. You can tokenize all types of traditional financial instruments and assets. And the way that the US regulatory system works is that we apply regulatory rule sets based on defining the asset or instrument. So if you tokenize a futures contract, it is still a futures contract, and it would be regulated by the CFTC. If you tokenize ownership over a gold bar, well, it's a gold bar. If you create a money market and you issue the security in a tokenized format, it is still a money market. So in many instances, the definitions are actually probably more clear-cut than many appreciate, but it does matter tremendously because it's going to determine, at least in the US system, which framework you're falling under. Now, the reason I flagged the technology as the first point, though, is that poses unique challenges for any regulatory rule set. So for a banking regulator or a state banking regulator looking at custody and trying to figure out, how do I get comfortable that this custodian is doing what it needs to do in order to safeguard assets? The question there isn't about what is the asset. The question is, do we understand the technology? Do we understand how private keys work and how you safeguard a private key? That's very different than a vault that would have safeguarded cash or a gold bar. So the legal significance of these definitions matters tremendously. There are some areas where there may be some marginal ambiguity. Obviously, we had, from 2017 to 2019, the ICO mania, which put a lot of pressure on the SEC to define, when is something an unregistered securities offering, and at what point might it become kind of a more broadly held commodity? And that distinction matters a lot, again, to determine which rule set applies. But I think what's really exciting, and this panel has already kind of flagged this, digitization and tokenization is a much broader concept, and it's going to hit traditional financial instruments and assets and impact the way that they're traded, transacted, and regulated.
Well, that is a lesson for one of the other questions in terms of the rule sets that apply, which is the robustness and resilience of the rails on which we are operating, whether or not they be sort of our Wi-Fi rails or other rails. But it does seem that that the Wi-Fi over the District of Columbia is, at least around my neighborhood, is currently unstable. But so let me just go to Zoe to ask then this other question. I mean, we had a discussion on clearinghouses or earlier, maybe a year or two ago, particularly in the context of crypto assets. There's the technology, there's the asset, there are the rails, and then there are sort of the intermediaries and the really the infrastructure supporting different kinds of transactions. Clearinghouses came up, exchanges have come up in conversations, particularly with regard to the intermediation that or at least blockchain technologies can decentralize critical infrastructures in many ways. Given this sort of the number of contracts cleared on exchanges, do you think, how realistic are these conversations? Because a lot of times when you talk about crypto can do, lots of things, but it's hard to sort of identify what are the upper bounds as to what is realistic when it comes to this really nascent technology and what it can do, particularly with regards to legacy infrastructures like exchanges. What's your view? What do you find exciting? What do you find as overblown? What do you find as intriguing?
None of it is overblown. It is more exciting than it was 3 years ago when I got a call from a headhunter to see if I wanted to join the board of Ripple. And only 3 years ago, I said, I have zero interest in that world. I don't understand it. And it's as Jamie Dimon said, who is my contemporary. I went to business school with him, actually. I kind of agreed with what he said 3 years ago. So 3 years later, I think it was Sarah that said, this is one of the biggest revolutions, paradigm shifts. Those kind of things don't happen overnight. So it's a false choice to say it's either the current exchanges that process in nanoseconds, millions of trades, or this thing. To me, the right way to look at it is, if you accept the fact, it is a revolution that involves both the technology and the cryptocurrency, the digital currency, that, as Chris Larsen, the founder of Ripple, says, the internet took a decade basically to have transfer of information, transfer of knowledge. You're talking about transfer of value. So it's huge. It will have a lot of bumps on the road, but it is unequivocal. It will change a lot of things. And the way I look at this is, I'm old enough to say I joined Morgan Stanley right out of business school in the early 80s. It was a private company. It was 2,000 people. When I left in 2007, it was 60,000 people, and it had offices everywhere. So that was a huge revolution, the one that said finance was globalizing, where you were putting users of capital with providers of capital in the global arena. That was huge. So to me, it's not going to take 20 years for this new thing to really cement itself. But it is beginning to disintermediate, to me, as all disruptions happen, from the bottom. And what I mean by that is, of the 7+ billion human beings in the world, over half of them are either underbanked or unbanked. So you're talking about the traditional finance that you're talking about. It works perfectly well, by the way. If you're Morgan Stanley wanting to send $1 billion to Citigroup, it happens instantaneously. And the Swift messaging system, or Swift 2.0, is perfect. So that's the correspondent banking system. If you're an SME in Nigeria, not so good. So this actually decentralized finance is banking the underbanked. It's giving access to the global financial system to the people that nobody has an interest in serving at the moment. So go ahead.
So when you get to that question, particularly on scale, when you think about different blockchain rails, there's always this question about to what degree can you really scale and support not just large transactions, but large numbers of transactions. I mean, how do you view that challenge? Where are we in terms of meeting that particular challenge?
So the technology exists, certainly, and it is, to me, fortunate with the incredible sophistication of cybersecurity. That has become very sophisticated as well. So I think the technology and some of these cryptocurrencies, by the way, they have very different use cases and design. So that's why people talk about Bitcoin. It is probably a nicer expression of digital gold, if you will. But in its design, each one of them has pluses and minuses in terms of scalability of transactions. XRP, as an example, its market cap isn't as large, to state the obvious, as Bitcoin, but its design, which actually was designed by the NASA scientists that designed it, as an antidote to the Bitcoin problem, which is it can transact in nanoseconds, very high volume, low value business. That's what it was designed to do. So I think there will be different rails, different utility tokens, if you will, for different use cases.
And Dan, I'm going to just follow back, since you obviously have a quite storied career over at the CFTC, and you've spent some time thinking about exchanges as well. How do you view the question of disintermediation, given what you saw over at Lab CFTC, and the potential for this particular technology as it pertains to sort of key infrastructures in that world?
Yeah,
like clearinghouses and exchanges. Like.
So it's a great question, and I'm gonna categorize some of these developments around crypto in the same way that I think about fintech kind of more broadly, and that is that some of these new underlying technologies and business models do seek to either disintermediate traditional players or transform the way that intermediaries operate. And I think both of those dynamics will occur here. So I'll try to unpack that a little bit. I think there absolutely will be new players. There will be new market entrants that will offer a fundamentally different way for market participants to trade and transact. That does not mean, however, that this is going to operate outside of the regulatory perimeter. I think instead it's far more likely that they will either become a new type of an intermediary or put pressure on regulators to recognize that traditionally defined intermediaries are now operating in a new way. As for traditional players, I think many will and already are adapting to these new technologies. And this is going to put pressure on regulators to keep up. I mean, I think Sarah and Zoe are case in point in terms of what we're seeing, within the market. Now, I will say, as a final point, I think this touches on this notion that's getting a lot of attention right now around DeFi. I think that as an initial starting point, there's a lot of incredible innovation taking place with software, with driving greater efficiencies, kind of reducing the amount of need for certain types of intermediaries. But I will also say that I struggle with the notion that this is going to be fully decentralized. So why do I say that? It's because at the end of the day, I think a market where trading occurs is almost by definition a centralized place. It's obviously a place where people congregate to trade. So there's a certain amount of centrality to that model. Now, again, it may be that the nature of the new business models or the nature of intermediaries is changing, but you may still have some intermediaries nonetheless. Now, so this is going to, I think we end up somewhere in the middle here. I don't think that a lot of these actors are necessarily going to end up fully outside of the regulatory perimeter. But at the same time, it means that regulators are going to have to look at the world where it currently is and realize that traditional definitions of intermediaries or traditional rules may make very little sense in this context. So, to take a very balanced view of this, I think we do end up somewhere in the middle. I think that you will have new market participants who will be winners in this system. I think you're going to see a lot of traditional players who adapt incredibly well, but it will still operate within a system that's regulated. And part of that is because I think markets demand, trust and integrity. And some of that comes from having a properly defined regulatory perimeter. It will require adaptation, though, on all sides.
I mean, certainly these are new technologies, some, without having had a long and established history. And so the question is, well, how do you create, trust and the like, and assurance in terms of their operation, but also in terms of their uptake? Perianne, what do you view as both the market and regulatory challenges associated with the adoption of digital assets, by institutional investors? What are you seeing in terms of how large asset managers are including them? I mean, obviously Sarah had outlined before, and I think you had as well, some interesting statements made by luminaries over in Wall Street. Where do you think that curve is heading? Again, with these asset managers, and what again are the regulatory and market challenges associated with those asset managers holding those particular digital assets in their portfolios? What are their major concerns, and what are their major interests?
I think we're still at very early days of institutional investors entering this space. And some of the challenges really have less to do with regulation and more to do with reputational risk. People just still don't really understand this, and they're not willing to put their career on the line to advocate for the adoption of cryptocurrencies for their clients. And two is education. Bitcoin, if we just kind of break this down, I'll just start with Bitcoin. Bitcoin has very little correlation to traditional asset classes, whether that's the S&P 500, US bonds, real estate, and others. In 2018, the St. Louis Fed issued a report, and they said, quote, Bitcoin will emerge as their own asset class and thus have the potential to develop into an interesting investment and diversification instrument. And that diversification piece is key. And that's exactly what we are just starting to see happen. So for investment advisors who understand this, and note that there's very little formal training and education around adding digital assets for investment advisors today. For those who have taken the time to really understand this or get to know it on their own, what they're seeing is that by adding just small amounts of a digital asset, whether that's Bitcoin or something else, into a diversified portfolio, it will increase the risk-adjusted returns. If you take a traditional portfolio with stocks and bonds and allocate even just 2% in the Bitcoin, the Sharpe ratio increases and risk decreases. And very sophisticated investors are starting to understand this. From Fidelity, Square, you have Paul Tudor Jones, Bill Miller, Drunken Miller. Public companies are starting to buy Bitcoin because of its diversification attributes, like MicroStrategies and others. So it's, again, we're in early days of institutional investors adopting this. We're starting to see a lot more traditional actors enter this space. And from a regulatory perspective, it's that regulatory clarity that continues to be a challenge. I think we have, decent understanding of where Bitcoin and ETH sits. But for XRP on down, there is very little certainty about if these digital assets are considered a security or not. So an issue that probably Zoe can speak to and sympathize with, because we don't have regulatory certainty for all digital assets. Different institutional investors may or may not be willing to take on that risk. And that's a big issue that the Chamber of Digital Commerce has been working on for a number of years with SEC, the CFTC. This issue has gone to the courts. There's members of Congress who have introduced legislative proposals to address this. But I do believe, I'm very optimistic, and I do think this will work itself out.
Can I just add something to what Perianne, I mean, what she said about diversification is spot on. But I would say the biggest issue with lack of regulatory frameworks, there's obviously the US issue of 3-4 regulators, each with their own views. But as importantly, when I look at traditional finance, it exploded in terms of positively, if you will, because you had a BIS, you had global institutions with global principle-based regulatory frameworks. So what Perianne said about XRP versus Bitcoin, it's really a US issue. In the UK, XRP is viewed as a cryptocurrency, in Asia as well. And so for me, the real focus for the industry should be, and that's early stages, I'm trying to find willing participants in this dialogue. How can we create the BIS equivalent, the principle-based global framework? Because if you're going to talk about cross-border payments, you need that global framework to work. That's one issue. The other about diversification, I would say the institutions are brought into this, Fidelity as well, and others, kicking and screaming. As Fidelity will tell you, 70% of their clients, it was reverse inquiry that pushed them into this space. And the reason I think investors, and that to me is the most critical point about in life, you have to be in the right place at the right time. Innovation alone is not enough. $190 trillion worth of stocks and bonds, 100 trillion in bonds and 90 in stocks. Again, in the 80s, if you were a 60-40, 40-60 portfolio, which is the 4 decades that made my career, you actually had 30-year treasuries in 80s were at 14%. And let's say that was not the mean. The mean was 5 to 8%. So you had risk-free rate of returns at 8%. Half of your portfolio being in a riskless asset with that yield is not that bad. And in stocks, you had actually cash flows. You had people that had not just a business plan, real cash flows, low leverage. So you had a 60-40 portfolio that produced exceptional returns. That $190 trillion now is half of it is producing zero, because the Chinese just issued 5-year bonds at 9 basis points. This is mainland China. So for me, the real issue, the 190 trillion, if 1% of that gets diversified along the lines that Perianne said, 1% is $1.9 trillion. There is,
Sarah, I'm going to sort of switch to this question, to even the more fundamental question of sort of the intrinsic value. I mean, when you talk about correlation, there's also this assumption of value, and even how do you sort of price, any kind of value to this, to these different kinds of digital assets. Just as a side observation, sort of as we move to the question of fundamental values, when we talk about institutionalization, I had once on my, I have a podcast called FinTech Beat, and I had Nick Carter sort of appear on that particular podcast, and he made an interesting observation, and I don't know what the data would show, but it had to deal with what happens, or really it's a query, what happens when you have more institutionalization of this particular, of digital assets? In other words, does the entry of institutional actors mean that they adopt to sort of a new asset class, and so they develop new tools, or are they bringing their tools to the new asset class? In which case, would there be some weird point of convergence as you have greater institutionalization, or are the most sophisticated people sort of saying to themselves, well, this is something different, so we'll develop other kinds of tools? And I think from what I understand from what he's saying, that's going to be something really interesting to keep your eye out on as the market itself sort of shapes itself out. But I get stuck on the very question of sort of the importance of again, the underlying value. I mean, particularly for institutional investors, there isn't a widely established framework, and this is going a little bit to what Zoe was mentioning, in terms of getting there, in terms of making an assessment. And as a result, many people do view price changes as the product of speculation as opposed to sort of changes in fundamental value. Sarah, like, how do you view this? I mean, do you think?
I definitely spend a lot of time thinking about it. And when I was working for Cameron and Tyler Winklevoss on my old job, we always kind of had the conversation being like, is this technology with a money overlay, or is this money with the tech overlay? And most of the time, I think that, all three of us came out of, the former, that this is really new technology, and, in which you can, has new sort of financial principles. In terms of valuation, I think, hopefully I don't offend too many people listening in, but like the kind of worst conversations I've had with folks about this technology have always been with money managers. And I think that's predominantly for two reasons. One, it's really difficult to value networks in general. And we've seen great investors like Warren Buffett just miss the mark in terms of understanding the compounding value of internet technologies. And then, like, to my earlier point, again, this is a new economic system where you have value embedded into the technology itself. And so say that you were like, if you understood the promise of the internet several decades ago, you were still investing in the equity or debt of internet companies. And so your valuation methodology looks somewhat similar to the other things that you were getting investment exposure to. This is totally different. So you have to understand the value of the network, and then you have to understand how these sort of virtual commodities exist within this network.
Could you explain that? Could you go a little bit further on that particular string?
Yeah, so it's so think of it like, crypto is if a blockchain was a car, crypto is kind of the gas that makes it run. And so again, you're talking about, a lot of times this technology being used as a way to, power these networks and create, alignment of incentives between all of these decentralized participants, which is a really, new concept. And I think that becomes, difficult a lot of times to understand the value of. So you have to understand the value of the network, and that means understanding that you have to underwrite the technology itself. So, what can I do with this computer software? How scalable is it? You have to understand applications that can be built on top of it, which is where the compounding value of kind of this type of technology comes from. And then you have to understand too, okay, so, if there's this cryptocurrency that's embedded into it, what does it do? Is this what I pay to send messages? Is this what I, is this used as a sort of a voting mechanism in terms of how a network is upgraded? And this is really, really technical stuff. There's now kind of a good base layer of, investors who are really approaching this technology really thoughtfully, and who are kind of underwriting all the different elements from a bottoms up perspective. But it's still sort of few and far between. And so, I would say when we think about valuation, we have to throw away a lot of old principles in terms of how we think about, valuing these types of financial assets, and, and really almost, transform our mind, to seeing the world in this new sort of decentralized way in which, these financial assets and technology kind of go hand in hand.
Yeah, that was a really interesting answer. I mean, Zoe, did you want to add to that, and maybe even also Dan? These are new kinds of instruments, different kinds of financial products, new different kinds of technologies. That valuation process. What should people be looking at when trying to gauge the value, and what fluctuations in value could possibly mean?
I think what Sarah said is spot on in terms of how do you think about the value of the network. The reason this whole world is being repriced parabolically higher is, again, the macro context, where journalists call me and they say, you've seen this movie before. And I say, no, actually, I've never seen this movie before, unless you're alive in the 20s and 30s. None of us have seen this movie before. And what I mean by that is we're now printing $1 trillion a month practically. So it's the macro context where the hurdle rate for investments has gone to zero. That's the hurdle rate. And so by definition, if you're investing in moonshot opportunities is 10x versus you lose some money. That's what VC investing is all about. And I think that's where we are. There is enormous amounts of money looking for a home. And they say, it's not zero, the possibility I lose all my money, because it could be all of the regulators get together and they outlaw this. I don't think that's the case, but it's not zero. But I could make 10x, 100x. So I think the value of those networks, which will succeed. I don't know if the current top players, Bitcoin, Ethereum, XRP, are the Netscapes or the MySpace or the Facebook or Google. But one of them will be, and the other one will be the other side. So that's why I think you have to superimpose the construct that Sarah described so well within the macro context, why this is a feeding frenzy.
Yeah, this is such an interesting topic, and I'd given a lot of thought to this a few years ago. I actually published a piece, thinking about how do you value cryptocurrencies, and it's interesting. I think that there is this concept that became very prevalent, especially during the ICO kind of mania days, that cryptocurrencies should be thought of, or at least from a valuation perspective, akin to a security. That there's going to be a pure supply and demand dynamic that's going to somehow continue to bid up a cryptocurrency into perpetuity. And then, it dawned on me as a thought experiment to maybe take cryptocurrencies at their word. Like, they're defined as currencies. That was the objective. That was the intent. And if you start to analyze valuation through a currency lens, you can go back fundamentally to a question like, what's a currency? Well, it's a unit of account, it's a store of value, and it's a medium of exchange. Now, I would suggest that to the extent a cryptocurrency is serving as a medium of exchange, actually being used for transactions, there absolutely will be a supply and demand dynamic up until some kind of equilibrium point. So what I mean by that is the day a cryptocurrency is created, there's zero demand for it. There's probably very little value. As people adopt it as a currency to actually use it to transact, yes, there's going to be potentially a finite supply. There will be demand, and you will see a curve that's going to potentially look steep. What it goes to, I have no idea. At some point of maturity, you would expect that it will start to operate as would any other currency. There will be some kind of like an equilibrium state. If anybody who's really into the econ, think about purchasing power parity, where you're going to start looking at currencies and saying, well, there's only so much you're going to pay for this currency if its absolute buying power has to equate to like what a dollar could buy you. So then where I think that leaves us in the long run is that the long-term values and long-term appreciation for a cryptocurrency, I think, will largely be tied to its store of value attributes. That's where you get into this conversation of like, is Bitcoin digital gold, digital silver? I like to joke sometimes, like I would say it's digital bronze. Like there's some hedging aspect to it. It's viewed as a hedge to the printing of fiat central bank money. And I think that could hold. I mean, I don't know what the answer is there, but that's a compelling justification. Now, I'll leave with this thought. I think that there's a limited universe of the number of tokens that we're going to see that would take on a true kind of ubiquitous store of value attribute. Like in my mind, maybe, and again, I agree with Zoe, I don't know if it's Bitcoin or something else. Maybe the world hones in on a few that really demonstrate stability and can be a long-term store of value as well as a medium of exchange. I'm a little more circumspect that we're going to have a world of thousands of cryptocurrencies that are effective as a medium of exchange and for some reason are also viewed as a true store of value. So that's really in the weeds.
That was an excellent and really interesting answer. Just to follow up with that, and then I think I'll ask both Sarah and Perianne, their thoughts, particularly in these last couple of minutes. When you think about the regulatory sort of topic du jour, and you yourself have been highly involved in it, is this question of of a digital dollar or a central bank digital currency. I mean, when you make that progressive move to CBDCs, what does that do to the conversation on all of the cryptocurrencies that we've been talking about? Number one, and even is that a tool? I mean, we haven't even gotten into the stable coin question. We need maybe an extra hour or two for that. But what does that do to your analysis? and how does it change perhaps how one goes about even that pricing process? Does having another sort of a digital fiat currency change the way in which you start to evaluate the pricing of different crypto assets?
So I'll try to be pretty quick with this because I know we're limited on time. I don't, from a digital dollar project perspective, and certainly my perspective, I don't view a CBDC or a US digital dollar as in any way antithetical to any further private sector innovation or ongoing innovation. I mean, I think the way I would think of it is this. Money printed by a central bank is the ultimate kind of public infrastructure, right? That is a central bank backed dollar. And we made a design choice at some point a long time ago that the way that most retail individuals are going to access a central bank backed currency was going to be through cash or coin. That's the way that most retail individuals would hold it, is literally a dollar bill or a quarter. What we're proposing through things like a digital dollar is that you can enhance the public infrastructure of money by creating a digital format of that cash and coin. Now, just as you saw happen with our current design choice, private sector innovation builds on top of and in the gaps of where you're going to have public infrastructure. I think that's exactly what would happen here. If anything, I'll leave you with one last analogy on this. You can think about it like the building of public highways. When the government created public highways, that's public infrastructure. Did that impact private transport businesses? Yes, of course it did, but it actually unleashed even more efficient, more effective private transport businesses. I think the same thing happens here. The innovation around programmability, specific use cases for money, all that you can do in terms of developing and designing smart contracts for ultimate efficiency around money and transactions, I think that continues to happen. I think if Bitcoin is truly serving as a store of value, well, that doesn't go away because there's a digital dollar. I mean, there's still plenty of room for these types of innovations. So I truly do see it as kind of lifting the fundamental infrastructure, and you'll see a lot of private sector innovation built on top.
Sarah,
that's a very key point that Daniel is making. And no one really knows what's going to happen with the introduction of a US digital dollar, other central bank digital currencies, and the continued growth of the cryptocurrency marketplace. The key difference I see between something like a US digital dollar and something like Bitcoin, it's not the technology, it's the monetary policy. And the reason why investors are buying Bitcoin and other digital assets today is because of it's operating as a store of value. Like what Ms. Cruz said, Bitcoin is an expression of digital gold. Where I think this is going is that you'll have Bitcoin as the foundational layer and central bank digital currencies being the transactional layer. But we have a long way to go in continuing to evolve the international financial and monetary system. But one of the things that I think is going to be key for central bank digital currencies to be successful is that they will be interoperable with cryptocurrencies like Bitcoin, like ETH, like XRP. So individuals have the option to go between different monetary policies based on what they're using it for.
I know we're out of time, but can I just add a point of diversification that matters? The mountains of money, the 190 trillion is the first point of diversification. And we said even 1% is $2 trillion coming into this space. The second piece, once it comes to this space, the religion of institutional money is risk-adjusted returns, diversified portfolios. So I'm working actually with a reputable, well-regulated index provider to say, what are the pluses and the minuses of Bitcoin? And there are some minuses in addition to pluses, XRP, Ethereum, Polkadot, which something didn't exist a few months ago. It's now hundreds of millions of dollars of value. And based on that diversified portfolio, you diversify idiosyncratic risk of each of those currencies. And so you have a bet on one of these winners, but you don't say, I'm going to put all my chips on red. I think that's a very critical point that 190 trillion understands very, very well.
Sarah, I'll let you have the last word if you had any thoughts on the CBDC and its implications for pricing and other cryptocurrencies.
Well, I think I agree with Dan in the fact that I think that this is really complementary to a bigger, system that is being built. What blockchain is really building a new and hopefully better internet. And so, all of these other, all these other ways in terms of interacting with it, whether it's, a CBDC or whether it's, essentially like a commercial bank token, are just creating sort of better on and off ramps in terms of, for everyday people or companies to be able to interact with this technology. And so, I don't speculate on kind of like the price of Bitcoin, and especially because I'm pretty bad at it. But I would say is that better infrastructure, whether that's provided by our governments or our banks for this technology, will make this technology more valuable.
Yeah. Well, I have found this conversation very valuable, as I'm sure all of our listeners have. It was really a pleasure to hear such expertise, and I certainly learned a lot. Thank you, Perianne, Zoe, Dan, and Sarah, so much for having joined us. I will be passing, I guess, the baton back, but again, I appreciate you for joining us here over at Georgetown.